Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to a new episode of Canadian Investing in the U.S. This week, my guest is Marcin Drozdz. For anyone who doesn't know who Marcin is, Marcin, maybe just give us a bit of a background, a little bit about who you are, maybe what you do, and we'll jump into it after that.
Thanks, Glenn. Thank you. So like Glenn, I'm a Canadian investing in the US, and I maybe complicated my life a little bit more than Glenn because I went to the US on the multifamily side from day one. I started in the private equity space in 2007, worked for a firm. We were buying 100, 200 unit apartment buildings in the US. Fast forward, built a few partnerships, built a few funds. And fast forward to today, still doing it. Different markets, but very, very similar strategy.
What's interesting, that's actually a conversation I've never had with you before about different markets. So maybe tell us a little bit about a story of like where you started, what markets were you interested in at the start, and why you pivoted to where you are now.
Sure. Well, and when I started, Glenn, I'm not going to any of this. I was kid just learning the business, right? So I worked where the firm was working. But as I look back at it, the reason why we were in 2007, 2008, 9, 10, we were very heavy in Phoenix, Arizona, that southwest quadrant of the US was really big for us. And a big reason for it was because for those of you who remember when the market crashed in 08, 09, those markets were very, very, very heavily hit, and because of that, there was a crisis in confidence on the investment side, and we were going down. We were buying apartment buildings for, you're going to laugh, $35,000, $45,000, $55,000 a door, and those same apartments today are $250,000, $300,000 plus a door. So that was a tremendous run.
Okay. So where are you buying now? What do you like right now?
So I love the South still. The landlord laws, the climate, the net migration patterns are really strong down there. But in particular, I'm quite enamored with Texas. And the reason why I love Texas quite a bit is because the last time the market crashed, so at the same time, 08, 9, 10, when we were in AZ and on the Southwest there, Texas was just business as usual. Actually, something called the miracle, you'll notice that Texas was like, no. Like, oh, recession? What risk? Like, yeah, it was kind of tougher, but it was nothing like the rest of the country. So, I love that market. I love that story. I think we're in, going in or we're in another recession now. And I think those value plays, those abundance of employers, the net migration factors, it's really important to focus on those fundamentals right now. And I mean there's other markets as well, as you very well know, Glenn. There's other markets too that are good during recessions, but I really love Texas for that multifamily story.
Yeah. And you just mentioned recession, which is a very hot topic right now. I know when we were sitting around the pool in Florida, we had a little discussion on recessions. I wasn't actually planning on going down this path at all, but it just triggered my memory. But I don't know if you want to go into this or not. I can cut this out.
Let's do it. It's on everyone's mind. We might as well talk about it.
So I remember you had a strategy, or you were talking about leading indicators. I'm trying not to like just rip you off, so you have something to talk about. But you're talking about like some leading indicators, and you're also talking about the length of them, and then the fear period, and maybe go into that a little bit, and then or maybe I'm gonna have to re-trigger your memory, but
Sure. Yeah. Look, so the one thing about a recession that most people don't really think of is when you're in a recession, it feels like forever. Like it literally feels like forever, and it feels like it's never going to end. And when the market's booming and houses are going up 10, 20% a year or a quarter sometimes, that feels like it's never going to end. So human beings, we have a very short term memory. And what's important to consider with the recession is if you look back, I think it's over 100 or 150 years. There was a chart I think I was showing you guys. The average recession, and I'm going all the way back to literally the 1800s, the average recession works out to about 17 months. And when you put that into context, it's not really that long. but again, it feels like forever while it's happening. And in a recession, something else happens. All the discretionary spending kind of goes away. Like it's like a vacuum, like immediately. And that's where I think a lot of the guys or gals with Airbnbs that they were buying for $1 million, $2 million and getting 20 or 30 grand a month in rent. And they were looking like rock stars because their mortgages were 2%, and they're pulling in 30, 40 grand in a month in rent. I mean, why wouldn't you do it? Well, now they're going to find out, because ultimately that market shift, that demand is going to go away. And as you're having to decide whether you're paying for groceries or you're going to go on that vacation, it becomes real simple real fast. So the three major leading indicators, I think I remember what you were talking about, the three major leading indicators for figuring out which markets have tremendous sustained value are this. Number one is net migration. So as simple as more heads equals more beds. So in other words, are you investing in a market that is at least status quo or growing to some extent? Because if you're in a market that is on a decline, then it doesn't matter how cheap you're getting something, who's going to live there? Whether it's 2 years, 5 years, or however many years from now. So net migration is a very big leading indicator. And what leads net migration is industry. So in other words, the jobs. Most people move for work. End of story. Very few people have the privilege to move because, they like the weather somewhere better. They, and that's evidenced in Canada. If you remember during the oil boom, we had people moving from, sunny coastlines up to the middle of northern Alberta because they were making 200, 300 grand. They didn't care. Fort McMurray, let's go, right? Like it didn't matter that it snowed however many months of the year. It was the cash, right? So people move for work. And if the opportunities are somewhere, that's where people are going to go. So especially now with the recession, you need to look at markets where you've got the kind of industries that, regardless of superficial demand from extra cash in people's pockets, are going to be there. And that actually goes to the third component, which is transportation. So in other words, are the markets that you're investing on the way, or are they just a bubble oversight of something that was out of the way? Is it something like a Me Too market out of the way? Case in point, I can give you guys so I'll give you two examples. One is Jacksonville, Florida. It's a great market for a lot of different reasons, especially during a recession. Because, and by the way, we're not investing there. I just like that market. I admire it for certain things.
Yeah.
And one of the things is it's got the second deepest port in North America, next to the one up in New York State. And what that means is all the boats from the Panama Canal, as they go across from their journey, they end up in Jacksonville. So all those dock workers, all those warehouses, logistics, the buses, the transports, Weyerhaeuser literally just made it was close to a $2 billion investment on the infrastructure, connecting the boats, the rails, the rail, train, air, basically like fully integrated core logistics corridor to ship logistics all the way throughout the US. Those jobs are not going anywhere. You're not going to download those jobs. You're not going to those are hardcore blue collar jobs that will be there for a while. Another example is Memphis. You've got FedEx, global world headquarters, not going anywhere. They're going to be shipping planes. They're going to be shipping goods and flying planes in every 24 hours. So you got to look at markets, whether it's US or Canada, cities. What are those anchor businesses that are, where people make a decent enough income where they could put good food on the table, but at the same time, they're not mobile jobs where somebody can just close a laptop, pack up their stuff, and go live somewhere else. So that's the other side of it. Industry people go, oh, tech. Yeah, tech's great. But literally, just like now, Facebook's firing people, Twitter's firing people, they're all firing Google, they're all firing people. Okay, these are $100,000, $200,000, $300,000 jobs. That's, those are not what I would call recession-proof economies.
Yeah, and you just mentioned like even doing that IT stuff. A lot of that could have the ability to work from home, and you could work anywhere, right?
100%.
So I don't know. Maybe this is an unfair question, but would you invest in places that like based on cars, right? Like I know certain parts, where, for instance, Birmingham, they have like Mercedes-Benz there. Detroit has a lot of things. Would it because that's one thing you can't really pick up and move, or at least they don't move it as easily, right? Would that be solid enough to be considered a staple? When I started investing in the US, I did it by myself and had to go through the growing pains of doing that. GlennSutherland.com/coaching. A 12-week coaching program done 1 hour per week over Zoom from the comfort of your own home. Classes are kept to 5 people to be able to answer everyone's questions. Shortcut the process. Make fewer mistakes. Curriculum available at GlennSutherland.com/coaching.
So I know a little bit about the car industry because my dad, I was kind of grew up in the car industry, ironically, with my dad running his auto shops and things like this. So, kind of learn things. And so what I heard in Canada, for example, Mercedes just sold off. My dad was literally just telling this. Mercedes just recently sold off all of their shops to they turned it into a dealer model. So you know how you go to like a BMW and it says Bud's BMW or whatever it is.
Yep.
So apparently Mercedes, to raise billions of dollars for their electric car lines and also their stuff, they sold off all the real estate and all the actual buildings to raise billions of dollars. And that's a major change in transition. So where I'm going with this is the auto shops and the plants. I think the big question is how much of an anchor is it, or is it an offshoot? So in other words, is it a major facility? Is it something that Mercedes or Honda or BMW or whoever, like I know Honda's big in the Carolinas, pardon me, BMW is big in the Carolinas. If they're investing heavily into future tech and robotics and all this other stuff, yeah, I think that's a pretty good assumption that, nothing is guaranteed, but if guys like that are going to invest billions of dollars into infrastructure, that is usually a really good indicator.
Okay. And we already gave kind of it's not a spoiler alert, but we know that you like Texas. We know that you like multifamily. Why Texas? Why multifamily? We're talking about like making it safer during a recession. What's the draw to Texas for you?
Well, Texas is sucking up the labor and a lot of the economics from other states. There used to be a time in history where it was more of a growing pie all across the US and things like this. Now the realities are that if you look at any of the GDP reports or any of the economic indicators, what's actually happening is any win that is in Texas is actually a loss somewhere else. And why is that happening? Well, first and foremost, Texas has cheap land, cheap labor, abundant labor, and it also has cheap energy. And the energy one is something that very few other states can compete with Texas on. And when you combine that with its proximity on the Gulf Coast, all the infrastructure, you got the Texas Triangle, which is the highway corridors, the roads, its proximity to the world markets. And of course, you've got the oil reserves, the gas reserves. Like there's so many things that they're doing right. And there used to be markets, like for example, Houston. The more I study Houston, the more I'm convinced that it's no longer just an oil and gas market. Like they have all the different manufacturing components figured out rather than outsourcing. They're bringing everything in. You've got LNG, you've got so many different Texas from all perspectives, it could literally be, it actually is in a lot of ways runs like its own country.
Like it's the size of Canada or bigger, right?
Well, I was literally about to say that so the Canadian economy is 1.7 trillion GDP per year. Texas is 2 trillion.
Yeah.
And that's just it's its own world. And again, history doesn't repeat itself, but it does rhyme. And if you do look at the last time we had a massive recession on a global basis, Texas fared pretty well. I have friends in Texas that told me they didn't even know there was a recession until they turned the TV on because everybody's going to work. Uncle George was buying a new truck just like you would anyway. Grandma's getting life is just progressing, and there were some bumps there, sure, but and the other thing too is and I don't want to get too political here, but the rules are a lot more pro-business in that state, whereas other states are a lot more, they're a lot more difficult to do business in. And you have, for example, Caterpillar, one of the oldest companies listed on the S&P 500. This summer, they announced that they're uprooting from Illinois, and they're actually moving their global world headquarters down to Dallas.
Ooh, there's something, yeah.
And they're not alone. Hewlett Packard Silicon Valley success story, head office is now in Texas. You know, Tesla, Texas, right?
So I'm going to pull this back to the real estate, which we were talking about real estate markets, but your multifamily buying, people aren't buying as much during this recession because there's a lot of fear in the water. Are you still buying?
I'm writing a lot of offers. I'm writing a lot of offers. Yeah. So look, yes, we're in the market. My due diligence team is working 24/7. We're cranking out a lot more LOIs. And whereas 3 months ago, our LOIs were ignored because we're very conservative in our underwriting and how we look at the future and how we, underwrite for our returns for us, for ourselves and our partners. And so when we were putting out term sheets, pardon me, the LOIs back in the summer and the fall, we were writing off about 10 to 20% against the whisper price. Now we're writing probably close to 30% plus off the whisper price. So, it's creating conversations. I think what's going to end up happening, Glenn, I'm curious to hear your perspective on the other side too, but I think the people that are at the table right now are the people that have to be at the table. And, unfortunately, I actually think that's going to be a lot more people next year because so I was at a conference last year and I was listening to one of the commercial mortgage brokers talk, and he was telling me, telling the audience that, and this was before the rates were going up, but he made a comment that now in today's context is very important. He mentioned that about a third of the bridge loans, which are the types of loans most syndicators took when they bought multifamily assets, are going to be maturing between 2023 and 2024, about a third. That is a big number.
Yes.
That is a very big number. And why that's relevant is because a lot of these syndicators initially took these loans at 3-4%. Now these loans are 7-8-9% because most of these guys didn't buy what's called a rate cap. So they didn't cap the interest rate that they were going to potentially pay.
So they're going to have to, they're either going to be upside down or really just trying to breathe, right? Or they're going to be
Yep.
forced to sell, right? Or looking to.
Well, yeah, I wrote an offer on a deal. The seller's still thinking about it, so we'll see. But they paid close to 20 million for an asset. Their goal was to sell for 28. They had an offer for 26. Interest rates went up. You know the story.
Yep.
We looked at the deal. I said, boys, the most even conservatively I could write on this thing is 17. And obviously they don't like that because they're upside down. But one thing I didn't mention to you is they're burning about $45,000 a month right now on reserves because their interest rate went up and they weren't anticipating it. So now they're burning through their repairs. The money they had for the renovations, they're burning through for the interest reserve. So they've got maybe 6 months.
So how are they going to renovate the property and make it worth more?
Well, they're not. And there's a saying in business, the first discount's the best, right? So, take the first discount, take the first sale, but, they want to go with it. So, we'll see. And Glenn, they're not even alone. Like there's another article I got to send it to you. It was a CMBS report on the entire mortgage market. And it said that forget about the bridge loans. It said that about 20% of the fixed rate loans that are out there are maturing next year or early 2024. And they believe that about a quarter of those loans aren't going to be able to debt service the new interest rates.
Huh. But on the same other side of this, at the start, you were saying like a recession is usually 13 months. And depending where you consider that to have started, it might be finishing off in partway through 2023 or 2024, right? So
what's interesting about this? So what's interesting about this, Glenn, and I think you definitely know this, is that the commercial market typically lags the residential market by about a year and a half as well.
Yeah.
So what'll end up happening is the recession, as far as consumers are concerned, because you got to remember the retail consumer doesn't care if the owner of the apartment building is having a problem. The point is they're paying their rent, they're living their lives, they're buying groceries, life goes on, so to speak.
Yep.
But on the commercial side, the guys that own the office buildings, retail, multifamily, whatever it is, their pain points are typically private, discreet, and it's a different kind of foreclosure. Like when an apartment building goes into a foreclosure, it's not like when a house goes into a foreclosure. Apartment building becomes a bank-owned asset. The bank has to turn around. They got to figure it out. So it's a lot more subtle in its form.
Yeah.
But it will definitely impact a lot of the people, unfortunately, that have made investments in some of these syndications.
That's really interesting to even think about the foreclosures as for an apartment building, because I haven't really thought about that a lot.
Mhm.
But so I know that banks are not the business of holding real estate or managing real estate, especially. So do they hire out a property manager and then manage the property manager? Because I know in like the residential space where I usually am kicking this around, they usually just will evict the tenants and let the place sit empty, or they'll let people stay there without paying until it's sold as a foreclosure.
Yeah. Yeah, the multifamily, it's hard to let 100 people stay for free.
Yeah, that's where
I
my
mean,
mind's going.
so what typically ends up happening on the commercial side is the banks will because you got to remember the way it works in banking, especially if they're acting as principal, not as broker in a transaction. So in other words, if they're lending their firm's money, their bank's money, their institution's money, then typically they have this rule where if it's your mess, you got to clean it up. So whoever the broker was that wrote the deal typically ends up having to scramble to figure out how to clean it up. And you got to remember the banks not worried about the equity of the previous owner or the owner. They're worried about getting their money, their fees, their costs. They want to get their cash out. So what I've seen happen actually back in 07, 08, I was a little green behind the ears at the time, but what I saw was some of the groups that we were working with, they were having banks call them and lenders call them on different transactions and say, hey, I know you guys own a property here. Are you interested in this property? And they'd say, well, what's the catch? There's no catch. Here's the loan. Here's the terms. Can you take it over? Basically, here's a free property
Yeah, no down
because
payment.
we know you could,
Yeah,
because we know you can operate.
yeah.
So that is a very real possibility where the lenders are going to be stuck with assets that they don't want to. And of course, a bank doesn't want to go through a sales process because that means they have to hold on to this thing for 3 months, 6 months, 9 months, and deal with brokers. And despite what some people think, banks don't ever want your property ever. They're not in the loan to own business. They want a return. They don't want any hassles. They want your reports on time, and that's it.
Awesome. No, and then like buying these foreclosures, do they list them the same way as they would for a single family, or is it more of like
No.
a pocket listing with a broker that's handling these?
So it'll be interesting to see how they handle it because it'll depend on the volume and the severity of the issues. Because if it's a one-off issue, and depending on the type of lender it is, if it's a one-off issue, it may not even publicly be an issue because it gets resolved internally. So in other words, you'll have, let's just say broker A has a client that just goes off the rails, can't handle it, blows through their budgets, just annihilates the transaction. That actual mortgage broker may have another client that they can say, hey, there's this other property, we're into it for X, can you help us out?
Yeah.
Right? That and those transactions, those never appear anywhere. The name on the management company changes and business goes on as usual. That's probably the preferred situation. But which is why it's a great idea to have really good contacts with property managers, people that know how to find things, because as these opportunities come available, they'll typically go to the people that have the most capacity to close. You think about a broker or a property manager or a bank, most of us, we don't want to have to do any more work than we have to. So if you know that if you call Glenn and Glenn can take that unit off your property, off your hands, no problem. Here's the check. Hey, great, perfect, awesome. That's what we all want. The second situation is if a lender, and I've seen this too, where a lender is into a group and they have 3 or 4 properties and they all go off the rails, that becomes a bigger problem. And those are the ones that sometimes get listed with the national firms, and it becomes a bank-owned property. It goes through the marketing process, and sometimes, unfortunately, those situations, depending on how much equity they had, the lender ends up taking a little bit of a cut too.
Mm-hmm. And they also just made me, I was reading an article, I think it was CBC or one of the Canadian ones anyway, and they were talking about like some of these mortgages, and the banks even just trying to have the ability to extend the loans for like longer terms or interest only, just so that people could keep making their payments and not have to take the properties back, right? I know that the lending in the US, you may not know the answer to this, but I'm wondering if the lending in the US, like because it's a little bit more flexible, if they would have that ability to just stretch this out or change it to an interest only or something to keep.
You're talking about extend and pretend, or
Yeah, yeah, yeah.
yeah,
No
that's
issue.
yeah, that's what they call it. I mean, look, every lender has some discretion. The bank, the lending channels are a lot more vibrant in the U.S. than they are in Canada. So there's just a lot more depth in the capital markets. And if there are creative ways to, extend things, make it interest only, whatever it is, all of that's very possible and very likely. And I actually think I think there's a lot of people suffering in silence right now exactly through that, where they're having a lot of these conversations with special credit, the bankers, the lenders, whoever it is, and they're trying to. I'll give you another example. So here's another warning sign. I'm getting calls from people that are property management companies all over the country, and I know that politely they're telling me that there's certain assets that are going to be potentially available, and I say, how do you know? And they're like, well, these people aren't paying their payroll, or they're behind on X, or they're behind on Y. So if the property manager knows that things are going to go off the rail, think about this. They want to make sure that they can, because they're doing their job. They have their people on site. They've spent money, time, and energy to onboard this property. They want to retain that client. So if they can bring you that opportunity, potentially, if it's required, if you step in, they can maintain that contract. They can maintain that cash flow for their business.
Yep, yep. That's what
And that's happening right now too. Like the biggest thing, Glenn, right now is there's serious crisis in confidence in the marketplace, and you have this massive disconnect where the sellers think that it's still spring 2022, and the buyers are all looking at the math. We all do the same math, and we're like, okay, you're here, I'm here. What would you like to do next? And I think the sellers that have to sell are going to be, it's going to be it's going to be forced. It's going to be forced upon them by the lenders. I don't think no seller, and think about it rationally, no seller would want to say, yes, sure, let's do this deal and let's lose money. But unfortunately, people took risks that were well above their pay grades, and now it's going to be, a reset.
Yeah. Marcin, I came up, like I even told you this before we started, came up with two questions I was going to ask you through this whole podcast. And it's basically
Okay.
differences investing as a Canadian and differences in raising money from Canadians. But I think maybe I'll have you come back because we went on a completely, that's why I love this, like just having a conversation and not actually following the script at all. But I think I'm gonna have to have you come back to do those topics because
Sure.
they're amazing topics, and maybe we'll hit it in like February or March or something, because I think it's a lot of interest to a lot of people. But before I let you go, let's talk about your offerings, your fund, your M1. Let's talk about what you have to offer for people before we let you go.
Sure. Yeah, I'd love to. So we have M1 Real Capital, which is our real estate investment company where we buy apartment buildings in the U.S. We have different funds. Our initial fund was U.S. Value Add Real Estate Opportunity LP, and we're buying value add. So I see value, and I see more value coming. So if people want to learn about that, that's happy to have the discussion. It is for accredited investors only, Canadians. In that regard, we do have Americans that are interested, and there's a different way to work together if they want to discuss that. And then we also have M1 Real Training, which has the training process for people that want to learn how to either raise capital, structure deals, build teams, invest in large multifamily in the U.S. and Canada. It's a mentorship. It's a training program. We have a couple hundred students across North America. And it's a great networking opportunity as well. So we have tons of free resources on the websites. We do capital challenges. We've got all kinds of different things that people can participate in, and it's been very well received so far.
Awesome. And if people wanted to like find that? You want to drop a website or something so people can go find this?
Yeah, my website's probably best. You have to put in the show notes in case people can't spell it, but marcindrozdz.com.
Yeah,
That's
He's
if they
dead at
just
the
Google
end.
my name. Yeah.
Awesome. Well, Marcin, thank you for coming on the show. Like always, tons of value. I love just I've always said that when I go down to Florida, one of my highlights is just sitting around and picking your brain. I love it. I love to talk to other people who are doing a lot of big things, and Marcin's definitely a person you want to get in a room with just to pick his brain.
Excellent. Hey, Glenn, let me know when I can get one of those hats.
Okay, next time I see you, I'll bring you one.
Looks good. I love your branding, by the way. It's very well done.
Oh, thank you. I'll have to tell Jamie. All right. Well, thank you for coming on the show. I really appreciate it. And like always, I love it. Thanks. Thank you so much.
Thanks a lot.